Hello everyone, hope you are doing good. Today we are going to see myths and facts about mutual funds. Myth: mutual funds are for experts. Myth clarified: in fact, mutual funds are meant for common investors who may lack the knowledge or skill set to invest in securities market. Mutual funds are professionally managed by expert fund managers after extensive market research for the benefit of investors. A mutual fund is an inexpensive way for investors to get a full-time professional fund manager to manage their money. Myth: mutual fund investments are only for the long term. Myth clarified: mutual funds can be for the short term or for longer term based on one's investment horizon and objective. There are different types of mutual fund schemes, which invest in different types of securities, in equity as well as debt securities that are suitable for different investor needs. In fact, there are various short-term schemes where you can invest for a few days to a few weeks to a few years. For example, liquid funds are low-duration funds, with portfolio maturity of less than 91 days, while ultra-short-term bond funds are low-duration funds, with portfolio maturity of less than a year. There are short-term bond funds which are medium-duration funds where the underlying portfolio maturity ranges from 1 year, 3 years. Then, there are long-term income funds which are medium to long-duration funds with portfolio maturity between 3 and 10 years. While equity schemes are most suitable for a longer term, debt mutual funds are suitable for investors with short-term, less than 5 years, investment horizon. Myth: investing in mutual funds is the same as investing in stock market. Mutual fund is an equity product. Myth clarified: mutual funds invest in stock market, i.e., equities, bond market, corporate bonds as well as government bonds, and money market instruments such as treasury bills, commercial papers, certificate of deposit, collateral borrowing and lending obligation, CBLO, etc. Many of these instruments are not available to retail investors due to large ticket size of minimum order quantity, such as G-SECs, and hence, retail investors could participate in such investments through mutual fund schemes. Myth: one needs a large amount of money to invest in mutual funds. Myth clarified: absolutely incorrect. One could start investing mutual funds with just 5,000 rupees for a lump sum, one-time investment with no upper limit, and 1,000 rupees towards subsequent, additional subscription in most of the mutual fund schemes. And for equity-linked savings schemes, ELSS, the minimum amount is as low as 500 rupees. In fact, one could invest via Duct Systematic Investment Plan, SIP, with as little as 500 rupees per month for as long as one wishes to. Myth: a scheme with a higher NAV has reached its peak. Myth clarified: this is a very common misconception because of the general association of mutual funds with shares. One needs to keep in mind that the NAV of a scheme is nothing but a reflection of the market value of the underlying shares held by the fund on any day. Mutual funds invest in shares, which may be bought or sold whenever deemed appropriate by the fund manager depending on the scheme's investment strategy, buy, hold, sell. If the fund manager feels that a particular stock has peaked, he can choose to sell it. A high NAV does not mean the fund is expensive. In fact, high indicates a good performance of the scheme over the years. Myth: mutual fund scheme with a NAV is 10 rupees per unit better than mutual fund scheme whose NAV is 25 rupees per unit, or a mutual fund scheme with lower NAV is better, or investing in NFOs are preferable than investing in existing schemes. Myth clarified: this is a common misconception. A mutual fund's NAV represents the market value of all its underlying investments. NAV of a fund is irrelevant, because it represents the market value of the fund's investments and not the market price. Any capital appreciation will depend on the price movement of its underlying securities. Let us understand this through an illustration. Suppose, you invest 10,000 rupees each in Scheme A whose NAV is 20 rupees and Scheme B, whose NAV is say, 100 rupees. You will be allotted 500 units of Scheme A and 100 units of Scheme B, assuming that both schemes have invested their entire corpus in exactly same stocks and in the same proportions. If the underlying stocks collectively appreciate by 10%, the NAV of the two schemes should also rise by 10%, to 22 rupees and 110 rupees, respectively. Thus, in both the scenarios, the value of your investment increases to 11,000 rupees. Thus, the current NAV of a fund does not have any impact on the returns. Myth: buying a top-rated mutual fund scheme ensures better returns. Myth clarified: mutual fund ratings are dynamic and based on performance of the scheme over time, which in itself is subject to market fluctuations. So, a mutual fund scheme that may be on top of the rating chart currently, may not necessarily maintain the same rating month after month or at a later date. However, a top-rated fund is a good first step to shortlist a scheme to invest in, although past performance does not necessarily guarantee better returns in future. Investment in a mutual fund scheme needs to be tracked with respect to the scheme's benchmark to evaluate its performance periodically to decide whether to stay invested or to exit. Myth: a mutual fund scheme invests in the same stocks as its benchmark index. Myth clarified: the benchmark index only serves the stated purpose, i.e. benchmarking returns. It offers investors the opportunity to evaluate the fund's performance. It need not always construe that an actively managed mutual fund scheme would invest in stocks that form a part of the benchmark index. Myth: funds with more stars/higher rankings provided by independent third-party agencies make better buys. Myth clarified: at best, rankings and ratings can serve as starting points for identifying a broader set of investment-worthy funds, but they are not the end to picking winning mutual funds. Myth: only small investors go in for SIPs. Myth clarified: please note that SIP stands for Systematic Investment Plan, SIP, and not Small Investors Plan. They infuse a disciplined investment habit of investing regularly and provide you the benefit of compounding along with rupee cost averaging. Myth: rupee cost averaging can be done in a stock itself, then why SIP? Myth clarified: SIP experimented on a single scrip, can expose you to more volatility unlike SIP in a mutual fund scheme, which reduces the risk, due to diversification provided by mutual funds. Myth: SIP mutual fund schemes are different from lump sum mutual fund schemes. Myth clarified: the fact is SIP is just the mode of investing. There are no special mutual fund schemes for SIP investments. Myth: lump sum investments cannot be done in a mutual fund scheme, where a SIP account exists. Myth clarified: SIP is just the mode of investing. Hence investing a lump sum amount to a mutual fund scheme where your SIP exists is possible. Myth: in case of SIP in tax-saving mutual fund schemes, entire money can be withdrawn after 3 years. Myth clarified: the fact is your every installment of SIP should have completed the lock-in tenure of 3 years for you to be in a position to withdraw. Myth: mutual funds means stock market. Myth clarified: one of the most common myths is that mutual funds are highly risky because they invest in stocks. However, this is half true. Only equity mutual funds invest in stocks and are risky. In fact, volatile is the right word, not risky. There are other categories of mutual funds called debt mutual funds, which do not invest in equities. They invest in bonds, government securities, and other secured investments. While debt funds have their own risks and even their returns are not 100% stable, still, debt funds are highly stable when it comes to returns and often provide better tax-adjusted returns than most of the bank fixed deposits. Myth: you have to invest big amounts in mutual funds. Myth clarified: many small investors stay away from mutual funds and stick to recurring deposits and other products because they think that mutual funds are for big investors and one has to invest big money in it. However, you can start a monthly investment of even 1,000 rupees per month in most of the funds. If you want to invest on the one-time basis, the limit is 5,000 rupees. So someone who is just earning 10,000 rupees per month and wanted to invest 10% of his income, can also start mutual funds SIP. Myth: I will lose my money if the mutual funds company goes bankrupt. Myth clarified: this is common thinking, but not true. Mutual funds are highly secured in terms of structure. The way it's designed and regulated by SEBI, it's almost impossible for investors to lose money due to a scam or AMC going bankrupt. Your mutual funds units does not lie with AMC, it just takes the decision of buying and selling units, and all the money lies with the custodian and highly secure. Myth: past returns in mutual funds indicate future returns. Myth clarified: while past returns can surely tell you that the fund did very well in the past and there is some probability due to legacy that it will perform well, but it's not written on stone. How the fund will perform in future is totally a function of what decisions fund manager takes in future. Myth: more mutual funds means diversification. Myth clarified: diversification is an abused word, at least in mutual funds. Just because you invest in more mutual funds does not always mean that you have achieved diversification. The reason is simple. A mutual fund invests in close to 50 to 100 stocks. So when you invest in an equity mutual fund, your money is already well diversified across sectors, types of companies, etc. When you add another mutual fund, most of the stocks might be the same and also in the same proportion, giving you very little extra diversification. When you add third fund and fourth fund, almost no diversification happens. Below is the portfolio of one mutual fund and you can see how much they have diversified already. Myth: mutual funds investments are complicated. Myth clarified: while investing in mutual funds is definitely as simple as creating a fixed deposit. But it's not too complicated. You need to do one-time documentation to start with, and once it's done, after that you can buy/redeem mutual funds online. Myth: mutual funds are not for retired investors. This is entirely false. Myth clarified: there are various kind of mutual funds which are suitable for retirement needs. You can invest your hard-earned money in debt funds and keep them secure while it's growing at a decent return. One can choose an option for a monthly dividend and get an income. One can also SWP from a fund, and withdraw a fixed amount each month. One can invest in debt-oriented mutual funds, which can have some equity component for some return kick. Myth: my money will be locked in mutual funds like other products. Myth clarified: many investors think that in mutual funds their money is locked for a specific period. In case of mutual funds, most of the funds are open-ended funds, which means that you can invest any time and redeem any time. There is no lock-in except in ELSS funds, which comes under ATC, and close-ended funds, which specifically tell you the duration for lock-in. Myth: only individuals can invest in mutual funds. Myth clarified: even companies and partnerships can invest in mutual funds. It's not limited to just humans. So if you are a business owner, you can also go for your business KYC, and then start invest in mutual funds. If you have money lying in current accounts, you can park your excess money in liquid or debt funds and redeem them anytime you want with a single click. Myth: mutual funds are unsuitable for youngsters. Myth clarified: any investment, if done without appropriate knowledge, can be dangerous. Mutual funds offer high transparency with respect to where and how the funds of the investors are invested. New investors could consider starting a systematic investment plan in a mutual fund, through which they could invest small regular amounts every month and gradually increase it over time. Financial advisors should be consulted for professional advice in investing, reviewing and tracking the performance of the mutual funds. Myth: you need to time mutual fund investments. Myth clarified: there is no alternative to hard work and discipline in life, and mutual fund investments are no exception. Just like regular and sincere work pays off in real life, a similar approach in mutual fund investments is also desirable to achieve financial goals. Market movements are unpredictable and one should not try to time investments. Rather, stay focused on your financial goals by investing regularly and success will follow. Myth: stop sips when markets are rising. Myth clarified: just like the total course of a medicine needs to be completed to get fully cured, similarly your SIP must be continued throughout its term to achieve the desired financial target. Rather than trying to time the market, you should invest regularly to reap the benefits of rupee cost averaging. If you have a long-term investment perspective, short-term fluctuation in markets should not alter your plan to meet your financial goals.
So friends, thank you very much for watching the video. If you like this video, then please like, share, comment and subscribe for more investment related videos.